All right, let's dig into a story about some absolutely mind-boggling numbers. We're talking about a record-shattering quarter from the investment giant Aris Management. Yeah, they raised billions, but the real story here is how they pulled it off and what it tells us about where the big money is heading. So, let's just start with this number, $30.9 billion. In just 3 months, the third quarter of 2025, Aris brought in nearly $31 billion in new cash from investors. That's not just a good quarter, it's the single best fundraising quarter in the company's entire history. Wild. And what happens when you have a quarter like that? Well, it pushes your total assets under management to this, a staggering $595 billion. To put that in perspective, that's more than the entire GDP of a lot of countries. So what is going on here? What's the secret sauce behind this kind of explosive growth?
Okay, so first let's just lay out the sheer scale of what they accomplished. Their own CEO called it an outstanding quarter, and honestly, that feels like an understatement. It wasn't just about that one big number. The growth was just everywhere you looked.
This slide really tells the whole story, doesn't it? You can just see the machine firing on all cylinders. Their total assets up 28% from last year. And here's the crucial part. The management fees they earn on that money up by the exact same amount, 28%. But look, they weren't just sitting on the cash, they were putting it to work, deploying a record $41.7 billion into new investments. This is a company that's absolutely at the top of its game. So, the big question is, how on earth do you raise and deploy that much capital so fast? Well, the answer really lies in this powerful dual-engine model they've got. They're tapping into two very different, but very, very large pools of money. Huge global institutions on one side and a fast-growing army of wealthy individuals on the other. Let's break that down. On one side, you've got the institutional heavyweights. We're talking about the big dogs, pension funds managing retirement money for millions of people, insurance companies, you get the idea. And then on the other side, you've got what they call their wealth channel. And this is all about giving high net worth people access to the exact same kinds of private investments that used to be only for the big players. And in this quarter, both of those engines were red hot. And check out this chart. It shows you where all that money is actually going. Now, your eye probably goes straight to that massive 59% slice for credit. And yeah, that's their bread and butter. But the key thing to see here is the diversification. They're huge in real assets. Think infrastructure. And they're growing super fast in areas like secondaries. That's basically just buying existing investment stakes from other people. It just goes to show they are not a one-trick pony. And here's the proof in the pudding. On the institutional side, they raised over $5 billion for a fund that specifically buys up existing stakes in infrastructure. That's one of the biggest of its kind ever. Meanwhile, the wealth engine brought in a record $5.4 billion in just 3 months. And look at that, 40% of it from outside the US, showing this huge global demand. All that landed them the number 2 spot in the entire industry for that quarter. Okay, so that's the how. We've seen the engines. But now let's zoom out to the why. Because our success, it's not happening in a vacuum. It's riding a massive wave. A huge fundamental shift in how money is moving around the world. And you don't have to take my word for it. The CEO, Michael Arugeti, he said it perfectly. Investors are looking for stable, predictable income, and they just aren't finding it in the usual places, the traditional stock and bond markets. So they have to turn somewhere else. And that somewhere else is the private markets. This is the crucial point, right? This isn't just a story about one company having a great quarter. It's a huge sign of a long-term trend. We're seeing a seismic shift. Capital is literally flowing away from public stocks and into these private deals for things like company loans, real estate, and infrastructure. And why? Because these private assets, they aren't subject to the daily mood swings of the stock market, which can mean more stable, durable returns over time. Okay, so things look fantastic right now. The trend is their friend. But what about the future? I mean, all we hear about is a potential recession, a turn in the credit cycle. So can this kind of performance possibly last? This is the elephant in the room, right? It's the big question on every single investor's mind. It's one thing to look good when the economy's humming along, but what happens when things get rocky? Well, when the CEO was asked about this point blank, his answer was pretty clear. He argued that all the bad news you might have seen recently about some high-profile bankruptcies, he says that's not a sign of a widespread problem. He called them idiosyncratic and isolated, basically one-off situations. And they have the receipts to back up this claim of being resilient. Just look at this.
During the global financial crisis, and then again during the COVID pandemic, Ares didn't just tread water, they grew their management fees at a 27% compounded annual rate. It's like they have a playbook for not just surviving storms, but actually accelerating through them.
And here's the secret weapon in that playbook, a massive war chest of what's called dry powder. It's $150 billion. This is cash they've already raised that's just sitting there waiting. It means when the markets get messy and everybody else is running for the hills, Ares has $150 billion ready to go find opportunities at bargain prices.
This chart just gives you such a powerful visual of that growth. I mean, look at the jump in their assets from just 1 year ago, Q3 2024 on the left, to today. That leap from around $464 billion to nearly $600 billion in just 12 months. It's a testament to a model that's built to capture this massive shift into private markets, no matter what the economy is doing. So after digging through all those numbers, all those details, what's the big picture here? What are the key things you should walk away with from all this?
Okay, if you remember 3 things, let it be these. First, the performance was just off the charts. Record fundraising, record deployment, you name it. Second, this whole thing is powered by that robust dual-engine model, grabbing cash from the biggest institutions and the growing wealth market. And finally, they make a really strong case, with history to back it up, that their model is built to thrive, not just survive, when the economy gets tough. And that leaves us with one final big question to chew on. You know, this story is about one massive company, but it points to a much larger trend. As more and more capital keeps flowing out of the public stock market and into these private markets, what does that ultimately mean for the future of the everyday investor and for the way all of us think about building wealth?